To what extent, as a bond man, are you irked and worried about global trade wars? To what extent does it price into your world?
Well, it's good news for the rates markets. So for the so-called safe havens, and here I'm thinking about treasuries in particular and maybe bonds, it's bad news for credit. So this starts with investment-grade credit and spills through into even high yield and emerging markets. And so it's a mixed bag, because clearly companies are the ones that could suffer if margins are revised downwards, and we have to reassess what the earnings outlook will be, and so maybe a repricing is appropriate. There's a kind of asymmetric risk actually to credit. And what that means is, if the spreads are quite tight historically, and you've got these shocks coming, the spread's going to widen.
Yes, I mean, because I wondered, reading your most recent piece of research, which we've pored over, Stephen, Slo-Mo credit crunch, it's already taken hold, you say. Reading that, though, there's not much mention of trade, and so I wondered if that's because it's just not material enough to factor into your sort of base case.
That's a good point. It's not that I forgot it or anything.
I didn't think
I've been focusing on what I call a triple whammy of tightening, which is financial conditions, the rate hikes, the balance sheet shrinkage, and the rejuvenation of cash. Now, Janet Henry and the global economics team are focused on a triple shock, which is the financial conditions about which I'm talking, and then trade and oil. And if you put those three together, it says that some of the more bullish growth forecasts we have in our global economics publications might be heading downwards, and that's sort of what happens. So the economic data the incoming economic data maybe ends up being weaker than expected, and the financial markets have been in a way responding to this all year. I mean, how many things have we discussed in the last 6 months? Crypto, reverse VIX, volatility on the S&P, and then every single event around emerging markets, starting with Argentina and Turkey and all of this. I think there's a common denominator. It's the tightening of US financial conditions. The threat of trade war is not good news for risk.
And Manus has got that chart, the tighter financial conditions, Manus.
Certainly. Well, we had hoped for tightening financial conditions, but instead what we got, Anna, was we're way ahead of the pack here. Stephen, good to see you. Let's just keep this yield curve up there for our viewers, because this is the core point, Stephen. You would say havens are bid. You've gone to the lower end of your call on Treasuries, 2.3%, but it's the two-year paper that you say, and we've seen a ratcheting in terms of the shorter end of the curve. You're calling for a much flatter yield curve.
Yeah, so the long end's done nothing all year. If you think about it, 30-year treasuries have been stuck around 3. The forward rates that I'm looking at, the 5-year rate, 5-year forward, has been stuck between 3 and 3.25. So there's nothing much to say. We're actually lower than that now. The real story, as you say, is the rate hikes and the upward path of the 2-year yield. And so the 2-year yield's been going up whilst the Fed's been hiking rates. I mean, nothing special there. That is completely normal. And the yield curve's been flattening, which to me, again, is normal. Now, you see, for the FX people, and here I'm talking about David Bloom and the team, for them, the short rate is the one that matters. So higher short rates propel or support the dollar rally. And, of course, the dollar rally has its consequences on emerging markets, or for emerging markets. And so, to me, the story is quite consistent. The flattening US curve tells you the structural story in the long end, which is looking through the noise, saying that we don't believe that the rate hikes will continue. We don't believe that the growth will continue. Focusing on structural issues like debt, demographics, technology, and all this kind of stuff. So the long end is doing that, and the front end is priced to where the Fed puts the short rates.
What is the long end? What is anchoring the long end where it is and stopping those rates from moving higher? Then, Stephen, is it the things that you mentioned, the things that are driving this slow motion credit crunch? Is it stock market sell-offs, volatility blow-ups and the like? Or is it the global context, global central banking policy being loose, and therefore there are lots of global buyers for US 10-years?
Of course it's both. I know that's not a particularly satisfactory answer, but it is, isn't it? So the excess debt means that the growth expectations that we would have had in previous cycles don't apply, because cash flow is deducted from investment or consumption and it's deflected towards saving. So the assumptions in the GDP calculations aren't right when you have to add an additional debt servicing cost. So that's one way of bringing to life the debt overhang, if you like. And demographics mean that old people hang around a bit longer working, and they don't need as much money perhaps, and so therefore they help add to the... I mean, there's many other things on the demographic story, but the reality is Labour hasn't done that well compared to capital in the last 10 years.
Yeah, and the sluggish wages story.
Yeah, so you get... So I think the long end is the most logical